All right, guys. So we are connected. You guys can see my screen and we're ready to go. So I'm going to start off. I'm going to make sure everybody can see by going through the slideshow and presenting from the start. All right, guys. So this is a stock market presentation. We are going to be covering various topics in the stock market. So feel free to ask questions like I was saying earlier. All right, so when you guys go into the stock market, a lot of times this is confusing to many people, and I want this to be extremely clear and easy to understand. So when you get into the stock market, there's a lot of things you can buy, a lot of things you can sell. But when it comes down to it, there's five major asset classes that you can actually buy and sell. And that is cash and cash equivalents is number one. So those are, obviously the physical cash that you and I have, this certificate of deposits, money markets, savings bonds, things that aren't going to actually, build in value and grow, but they're going to be there physically. And so it's kind of a safe play. And then you get into stocks. So stocks is the big thing. Everyone's obviously always talking about stocks, other known as equities. So as you can see here, I list out a few stocks well known that you guys are very well accustomed to. So Apple, Tesla, Facebook, and Microsoft. So stocks are simply ownership in a company, to keep it basic. So you can buy and sell shares in different companies that you want. And pretty much the investing world has made this almost, available for any investor. So there are a lot of companies that are now offering, $1 fractional shares of different index funds or different mutual funds of stocks, which is a group of stocks. And it's almost made it impossible for people not to invest at this point. Like it's almost, it's everyone needs to be investing, and they've made it so accessible to everybody for a very small cost and very low buy-in. So they've kind of removed the barrier of entry. Then you get into bonds. So these are also known as fixed income. And this is a debt instrument that companies outsource to an investor. And they say, hey, I'm going to take on this piece of debt. And then you're going to pay me the debt piece back plus interest on top of that as a fixed income payment. So we're going to determine the price of the bond and the return and yield on the bond before you even take that piece of debt out. So basically a company's borrowing your money, and they're going to pay you a thank you through interest. And the reason why I put, Apple, Tesla, and Facebook was because you can buy bonds through companies just as like you would buy a stock. The different picture here is the White House. And so the reason I did a picture of the White House instead of Microsoft is because you can actually get city, state, and governmental federal bonds through those different entities outside of an actual company. And that's a little different than a stock because you can't get stock in the government. But there are governmental bonds and all of those kind of things available to the investor if they want to. Then you get down to real estate. Real estate's obviously a big one. There's personal residence that a lot of us have, you and I have. There's commercial properties that are available, and there's rentals. A lot of real estate guys are into rentals. But one other thing that's really cool is a REIT. And a lot of people don't understand a REIT's actually an investment such as like a mutual fund or an index fund. You're buying essentially a group of a group will be out and doing a real estate investment, right? So they'll go out and buy a commercial property, one or two or three, and they'll have a bunch of funds. A REIT is being able to pay into that fund and basically investing into that, that management company that's running all these rental properties all over the place, in a nutshell. So you basically are part of real estate and getting real estate exposure, but you're not actually dealing with the tenants what you would deal with like a rental. So it's a little better if you want to be in real estate, but have a passive, investment into real estate and not have to worry about all that. And then lastly, the big one is commodities. And you guys probably can point these out and tell what these are is gold, silver, and oil. So there's multiple commodities, but these are the big ones that a lot of people talk about. And these are just, for the investor, it just depends. There's a lot of investors that actually use gold and silver as a pretty big portion of their portfolio. For example, Ray Dalio, who's a big hedge fund investor for Bridgewater Associates, he has 15% in the all-weather portfolio he talks about a lot. So they have a role It's not for every investor, but it's available to you. And that's what this slideshow is. So then you're looking at the historical returns before inflation. So the gross returns on all of these assets since the beginning of time when they started tracking the market in 1926. Obviously, these things were in place well before 1926, and there's, unrecorded data, but this is roughly an estimate since 1926. And as you see, cash is zero return, and with inflation, this is before inflation, but if with inflation, it's actually a negative return, so -3. So keeping a minimal amount of cash is always really important. Stocks is obviously the big guy here, averaging about 10%. So that's what the S&P 500 has done since 1926. Then you have bonds hovering around 5%. Real estate's down to 4. And so real estate, I always get the question, there's no way real estate's way higher than that. It really depends. And this is a very, very general estimate, but there's real estate in different markets that is going to vary greatly. So this is just a general total of all of that real estate. So there could be, lower returns and also higher returns. So I just want to clarify that. I think commodities are hovering around 3 to 4% as well. So those are the historical returns, something to be aware of. The number one thing most people go to is looking at this big stock block and saying, hey, 10%, why would I not just invest everything in here? And so I would say as an investor, make sure you're looking into the purpose of your portfolio. Every single asset comes with its own benefits and also its cons. So as a stock, that's awesome. It's growing 10%, but there's also bigger drawdowns. So let's say the market dips, you're going to have bigger drawdowns than if you were in commodities. That's going to be a hard real asset that's not really going to lose much value and kind of stay similar, which is kind of the allocation of capital versus allocation of risk argument. So one of the biggest tools I use when it comes to investing is the Morningstar website. So I go to Morningstar all the time, just morningstar.com. And they have this really cool investment style box I often, refer to if I'm looking into different investments. And I think this is really helpful. So let's break this down. It's really simple in a nutshell. And so there's two pieces of it. There's market cap and investment style, as you see on the left-hand side, and then investment style up here. So if you're looking at the market cap specifically, we're talking about a company is going to go public, let's say Apple, for example, and they're saying, hey, I'm going to go, put out 300 shares. Obviously, they have a lot more than that, but let's say they put out 300 shares. So that's the outstanding shares. This is the calculation here that actually calcs market cap. And so like outstanding shares, let's say they have 300 shares and the share price is $100. Well, their market cap would be $300 or $3,000 at that point, right? If I can do correct math. And so when you look at this, the size of the company isn't necessarily the size of the revenue of the company, the size of the people at the company. It's actually the market cap is just the outstanding shares times the share price, how much money is out to the public essentially out in the market. And so that's how they determine market cap. And as you can see here are the breakdown. So under 2 billion is a small cap company. So you'll hear small cap companies are a lot more risky. So as you can see here, there's an increasing risk as you go down. The farther you get down here, large caps less risky, mid caps, a little more risky, and then you get into the redder and more red, and it's small is the most risky. And so then you see mid 2 to 10 billion and large 10 billion plus. So market cap, that's how the S&P 500 is weighted. So if you ever look at the S&P 500, it's actually the 500 largest market cap companies. Then you get into investment style. So this is the top piece right here. So value, blend, and growth. And it's kind of just what it sounds like. Value is something that has good value, right? Low priced stock relative to the earnings. There's a lot of famous value investors out there like Warren Buffett. So they ultimately are using value style investing a lot of times. And then you get into, let's skip to growth over here, and that's expensive relative to earnings. So the reason that is like, let's think of an Amazon or somebody that's rapidly growing, a Tesla recently. Their stocks are growing extremely fast. So investors are really buying into it really, really fast, but they're not necessarily providing the return. They're expensive, but they're also in growth mode. So they will eventually come back down to earth, but it's one of those things where you kind of catch the ride up and try to take advantage of some of that growth. And it's more risky, but a lot of times the investor an early stage investor might be able to take on that type of risk with their portfolio if they're a younger investor in the game. And then you have the blend is just pretty much a mix of both. You see, core concepts of value and growth here. So this is a common rule of thumb when it comes to investing. So a lot of people are like, hey, there's tons of assets available to me. There's tons of types of investments, equities in particular, with the Morningstar box we just looked at. How do I know if I want a small cap, all that kind of stuff? Well, here's a good rule of thumb. So take the number 120. Some people use 110 or 100 as this base number, and just subtract your age from it. And that's approximately how much stock you should have in your portfolio. So that could be individual stock, that could be index funds, that could be mutual funds. We'll cover those in a second. But basically stock. So if you're, let's say 30 years old, I'm 29. So let's say 30, 120 minus 30, it would be 90, right? So that would mean I should have 90% stocks and 10% other asset as a rule of thumb. And so if I was like, hey, you know what? I'm 29 years old. I don't need to have other assets. I really want to go risky. I want to be 100% stocks, which is what I'm currently at. That's fine. This is just a rule of thumb to kind of give you a starting point to see where approximately you should be. So then you get into kind of furthering the types of assets, but the investment products behind those types of assets. So as we all know, we always think of stocks as individual company stuff. So that's what a single asset is, right? You have an investor right here. They're basically going straight to the broker and buying in the market and just buying the stocks and bonds directly, right? The technical definition here is any resource owned by a business or economic entity. It's anything that can be controlled or owned to produce value that's held by an economic entity that could produce positive economic value. Examples: Apple stock, government bonds that we talked about, gold. So it's just cutting out that middleman and just going straight to the source and buying them yourself. But then there's other options. And so if you guys have been following me for a while, you will know I'm an index fund investor and a mutual fund investor. So what this is basically eliminates a lot of risk with individual companies. So there's nothing wrong with investing in individual companies. It just depends on the investor preference. And so when you look at different investments, you're going to say, hey, do I want to take on the risk of having an Apple or a small cap company individually, or do I just want to put my money in a pot and buy a bunch of companies? What's better for me? And so a lot of times people will say, hey, what's my favorite stock? And I'll say, well, I don't really have an individual favorite stock. I kind of look at the index funds and mutual funds as my favorite thing. So as you can see here on the picture, you have the investors, they're putting their money into the pot right here, and they're giving this to a fund manager. And so this fund manager is going to go run one of these funds. So VFX, for example, is the S&P 500. That's a passive fund. So you're not really going to have a fund manager with that, but it's also a mutual fund. And we'll get into that in a second as to why that is. Then you have like VDIGX. So this is a growth fund essentially. And in order to run a fund like this and to outperform the market, the VFX, you're going to have a fund manager that's going to buy and trade and sell securities such as stocks and bonds that are going to beat the market. So you have to actually pay an extra expense, which is the expense ratio on these types of funds and mutual funds, actively managed mutual funds, to pay this guy right here who's buying all the stuff for you and selling it back and basically getting you your return. So that's a great way to invest. So investment that pools the individual investors' money together with other investors to purchase a share of collections of other stocks and bonds or other assets. So that's a really good way to invest. And I highly suggest, especially beginner investors, playing it safe and being in a mutual fund or index fund. I preach low-cost index funds just because they're cheaper than actively managed funds, and they usually outperform. Recently, you've been hearing about ARK, right? So ARK, okay, that's run by Cathie Wood, and that would be considered a mutual fund. So you're paying. She's basically this right here, this picture, and then you guys are the investors up here, and that's what she's basically doing. So then you get into ETFs and index funds. So ETFs are very similar to index funds, but they trade like a stock. So you're still looking at the same picture. You're still kind of doing all the same stuff, but this middleman's kind of cut out. it's pretty cheap. VU, for example, is the S&P 500. VTI is the total stock market, and QQQ is another really good option for you. So ETF is a type of investment product. They're traded on stock exchanges. So they're basically a mutual fund or index fund, but they're traded at the time that they're sold. So when you sell a stock, if you put a market order in for that, let's say 12 o'clock during the day, it's going to go, into, you're going to be able to buy or sell that at that time, right? With a mutual fund or index fund, it's different. It trades at the end of the day. So if the price changes, then you're kind of out of luck, which is a lot of times why people move to ETFs, so that they can kind of have more control on their investment, but still have the core investment, like an index fund. Because if you look at VU, like I said, S&P 500, when we look at the next slide, it's pretty much the same thing as an index fund, but it's more accessible and tax efficient for you. So lastly is this index fund. So, you have VFX here, which is the S&P 500. So that's the equivalent to VU. So the S&P 500, the top 500 companies, it's different because, like I said, is you're not able to trade this in the middle of the day. That's pretty much the only difference. The other difference of ETFs and index funds are the buy-in. So index funds through like Vanguard, for example, have a $3,000 minimum. Whereas ETFs have a lower barrier of entry where you can just buy the share price for, like, let's say $200, and you don't have to have $3,000 on hand. It can just be a quick $200, and you can start investing like right then and there. So oftentimes, if someone's like, hey, I want to invest in the S&P 500 through Vanguard, but VFX is kind of expensive, it's $3,000. A good starting point would be going to this ETF and buying VOO until you have enough capital for $3,000. And at that point, you can say, hey, I want to keep this ETF. It's the same thing. I have more flexibility with it. Or I'm going to sell my VU shares essentially and buy VFX now that I have $3,000 and I don't have that barrier of entry, and just hold index funds for the long term. Either or is a really good option. But as you can see, I hope this visual kind of helps you guys understand what's going on with these types of investment products that are available to you guys. So we talked a lot about, those types of investment products, assets. One of the biggest accounts I like myself is I call it the Freedom Fund or the taxable brokerage. I know Chris uses this a lot, versus like retirement accounts where you hear like a Roth IRA or 401k. I love the taxable brokerage account, but you have to understand the tax implications behind it. So this is a really good breakdown of how your actual investment earnings within this account are going to be taxed. So with retirement accounts, they're tax-free. They grow tax-free, and you don't have to deal with a lot of this stuff. But with the taxable brokerage account, it's a little different of a story. So capital appreciation or depreciation would be the increase or the decrease in the value of the asset. So when you have, let's say, buy Apple and it goes up from $1,000 to $1,001, you're technically earning capital appreciation of $1 in that scenario. So if you hold that stock for, let's say, a year and you don't sell it, and then, a year passes and 10 years down the road, you decide to sell it, you're going to be taxed at a long-term capital gains rate. However, if you sell it within a year, if you're like, hey, this happens with people that day trade or are trying to in and out of the market, they will actually be taxed at the short-term capital gains, which is the ordinary income tax rate. So your ordinary income tax rate is always going to be a little higher than your long-term capital gains. Most people are paying 15% in this long term, whereas short term, it just depends where your income tax rate is. But this short term is always going to be higher than your long term. I think the cutoff is $40,000 and below. I want to say approximately is 0%. 40,000 to 440,000, which is why I say most people are in that range, are going to fall within 15%. And anything over 440,000, you're going to see 20% on your capital gain. So that's if you go to sell that asset or security. And then you also have dividends, right? So a lot of dividend investors in here probably. And so it's more than just the stock increasing or decreasing. This is actually the thank you payment from a company. So you have qualified dividends and you have unqualified dividends. And so the qualified dividends are taxed just like the at the capital gains rate, like the long term, and the unqualified are taxed like the short-term capital gains up here. So ordinary income tax rate and such. And then you lastly, you have interest, and that's like off bonds, like we were talking about earlier with fixed income payments from bonds. Your interest earns tax at the ordinary income tax rate on these. So that's a really good tax slide to probably go back and reference a lot. A lot of times I get in the tax chat and Wealth Squad, I get this question a lot. I pretty much just have this memorized in my head to where I can reference it real fast. Okay, so we talked about the taxable brokerage. One of the common things with investing, I always say everyone probably needs an IRA because everyone needs a retirement account of some sort. Obviously, we could stick with taxable brokerage, but it's nice to have that tax-free growth. It's nice to have something knowing that we're at 59 and a half, we're for sure going to get this, right? And so these are the steps. I'm going to walk you through the steps and we can talk through them briefly, but they're good reference steps. If you guys actually want to go open a Roth IRA, this is exactly how you do it. So this is through Vanguard. These are the steps. So step one, you go to vanguard.com, click on personal investors. As simple as that. These visuals will be the same. The picture might change in the background, but in general, it will be the same. Then you go to step two and you go to this investing tab up here and you click the investing dropdown and you click on account types, IRA and Roth and traditional. Then you see this screen, you say, hey, I want to open an IRA. You click, this is speeding up on me, guys. Then you click continue. And then you start filling out personal information. You go tell us about yourself, obviously, what this is for. You establish your funding. Is this coming out of my bank account, my paycheck, whatever? Review and sign, next steps. And that's where you get to mail in the required forms. And then you basically have this set up. So, Vanguard's kind of old school with the mailed in forms. That might have changed since. But I'm pretty sure my brother just opened one over the summer and that was the case. So it's been pretty recent that they still do that. Then you can pretty much set everything up and have everything ready for retirement. And I highly recommend you guys, anybody out there thinking about a Roth IRA, that's one of the most like fundamental accounts that anybody can get into. Grow tax-free, guarantee yourself to be a millionaire if you max that out for a substantial amount of time. In 2020 and 2021, the contribution is $6,000 per year. So a little hack for anybody that's looking to do this. If you haven't done it for 2020 yet, you actually can open a Roth IRA today up until April 15th, which is the tax deadline, and say, hey, I'm going to characterize my contributions as April 2020, or sorry, the year 2020. And so you can actually invest for 2020 first. And then going forward in 2021, you can characterize the other 6,000 for 2021. So you'll have $12,000 invested in the year, just distributed between 2020 and 2021. So that's a good hack. If you guys want to open that Roth IRA and have it for 2020, you can still do both. So then you guys actually get into the investments, right? So we have these investments. We talk about these investment products, all this stuff, and we talk about these accounts, but we never actually, a lot of people don't understand like how to actually go in within an account and select a fund. So this is a really good diagram that you guys are going to learn here of how to read a fund. So people get overwhelmed when they go into their 401k and they see a bunch of long list of just gibberish essentially. And they're like, I don't know how or what I'm looking at. Can somebody please break this down? And for the average person that hasn't ever dealt with this, it's really tough. But here's a really good breakdown. So when you're looking at the fund, this is pretty common across the board when you're looking at these as to how these kind of lay out. So you always look at the left to right, right? Just like think about diagramming a sentence in grade school. So your first one's Vanguard. So this is Vanguard example. I like to use that because that's who I use. So that's the broker, right? That could be Fidelity, that could be Charles Schwab, that could be whoever owns the fund, or iShares, I think is one. All of those. Then you get to the second box and you look at what type of investment is this? Is this long-term, short-term? And it's going to kind of tell you what's the game plan for this fund. Is this a short turnaround fund with high turnover, or is this kind of there for the long term? Then you look at the type of asset. And so that's bond, equity, real estate, whatever you're looking at for like the 5 assets that we looked at earlier. Then you get into the investment product, and this could be ETF, mutual fund, index fund, the investment products we looked at earlier. And then you look into the share class. So the share class is a little different name-wise, naming convention through different entities. But essentially at like a Vanguard, what they do is saying, hey, for the first $10,000, you're going to have what's called the investor share class, which is basically a higher expense ratio. But once you have $10,000, we're going to basically say, hey, thank you for putting so much money with us. We're going to basically increase your shares to Admiral shares, what they're called, and decrease the expense ratio, let's say 10 basis points from like 0.14 to 0.04, so that people understand like, hey, if you have more money invested, you're actually incentivized to do so. And so we're going to actually give you a cheaper price. And this is how the wealthy get wealthier, right? The more money you put into the market, the more incentivized you are, because that's the way the capital markets work. And that's how things are run in America, essentially. And that's why you see the wealth, gap is so large, because people that continually invest are continually getting all these incentives and benefits, and leaving politics and that conversation out of it. There is a lot of incentive to do this. So to have more and more money invested, you continually get better and better incentives. And this is kind of a small scale example of what that is. And then, as you guys know, ticker symbol, I'm sure most people know, that's the short like code essentially that you could look up if you're like quickly searching for a fund on like Yahoo Finance or something. You would basically just say, hey, VBLAX. That would stand for this entire long thing here. Same thing for like VFX. When we were up in the slides earlier, we were kind of talking about those. So I hope that helped. I'm going to, that's the slideshow, but I want to look in the question mark box and see what all we have, if we have a bunch of questions. So I'm going to go ahead and scroll to the top real fast and see if I missed anything, and then start answering the questions. And then obviously, if you guys want to, you guys can talk out loud and just raise your hand or whatever and ask me questions. Let me answer a few questions in here first. Okay, this is a good one. So once I invest in a stock, should I be keeping tabs on it all day? If not, how often should I be keeping an eye on it? It depends what type of investor you are. If you are in the Wealth Squad and you're looking at Chris's plays that he's posting in the options or the whiteboard chat, you pretty much have to keep an eye on it, because you're looking at the charts and you're paying attention to technical indicators and all that kind of stuff. But if you're buying like an Apple and you're just saying, hey, I want to invest in this company for the long term, you don't need to pay attention to the daily news. You don't have to pay attention to all that kind of stuff. So it just depends what you're trying to do with that investment ultimately. And so I'm going to say both ways are okay. I don't like to pay attention to the daily, and a lot of times people don't have the time to, right? So they're waking up, they have kids, they're trying to get them to school, then they have a job 9 to 5, they get home, they're making dinner and all that stuff. It's really hard to stay up to date with the latest stock news, the charts and all that kind of stuff. So people just want to buy and invest, and that's where the mutual funds, index funds, ETFs come into play, is where you're buying a big group of stocks and you really don't need to pay attention to the daily news. Yes, good point, Nikki. So Nikki was mentioning, so if you are a Vanguard investor, so like when I was a Vanguard investor technically through my 401k. And so you won't need to mail in those forms if you're already a Vanguard account holder, because they're just trying to basically verify your social security and all your personal information. So that's probably the first step I did when I first got my 401k. But once I was enrolled, when I opened my Roth IRA through Vanguard, I didn't have to go through that process, but my little brother did. He was 18 years old and I was trying to get him started early. And he had not opened an account. Obviously, he didn't have a 401k or anything, so he had to go through that process. So I guess, yes, it is dependent on if you have an account or not. Fidelity is a good choice. Yes, the short answer is that Fidelity, Charles Schwab, and Vanguard are the big three I talk about often. So Fidelity is awesome. They have really good low cost. They've really lowered their costs on like FZ Rocks, which is like the total stock market index. The expense ratio, and that's actually 0. Vanguard's is 0.04, both extremely low, and pretty much minuscule, but Fidelity's been awesome. Can you please explain that hack again? Adrian, can you chime in with your mic and ask me what do you mean by that hack? Great information because I opened a Vanguard and I know what you're talking about. You're referring to the 2020 contribution and the 2021 contribution, is that correct?
Yes, but someone already answered it in the chat. So
Okay.
thank you.
Gotcha. Yeah, I'm just kind of reading down, so I'm not caught up yet. Yeah, totally went over my head. Is this recorded? Yeah. So for anybody, I'm going to briefly cover that for anybody re-listening to this recording or somebody that missed it is, so when you go into invest, like we have IRS limits around these accounts with retirement. So 401ks and IRAs have account limits, how much you can contribute per year. And so every single year they change the limits. Right now, currently in 2021, it's 6,000 for the Roth IRA and 19,500 for the 401k. If you're above 50, you actually have what's called a catch-up contribution, and that's plus 1,000 for the Roth, so 7,000, and plus 5,500 for the 401k, which is 25,000. And basically, you have the ability to invest into that account up to that amount each year. So one of the hacks that I was referring to is if you have not invested for 2020, until taxes are filed in April 15th, the tax deadline, you can actually characterize your contributions right now, tonight, if you went ahead and opened a Roth IRA and say, hey, all my contributions that I just invested, essentially, let's say 6,000, you maxed it out, count as my 2020. So you can basically discount that to the year before. And then going forward, you can say in 2021, from now until the end of the year, everything I've contributed is going to be towards 2021 contributions. So it's a quick way to, if you missed out on last year, to take advantage of last year as well, the limit that you have. So question is silly, but can you have, first off, guys, no bad questions. Seriously, ask me whatever you want. That's why you guys are here, obviously. I ask stupid questions daily at work. So always opens, have questions readily available. I don't care what it is. Question is, so can you have multiple Roth IRAs? Technically, yes, but you still have that contribution limit that you have to adhere to. So you have to have that $6,000. So you could have 6,000 Roth IRAs essentially, but you could put $1 in each one and have $6,000 total. So there's really no benefit. So obviously the question there is prying at like, hey, could we open like 4 of them and put $24,000 in per year? Unfortunately, no, you have to stick to the limits regardless of how many you have. But there's other accounts out there that you could do, the 401k. If you don't have a 401k and you're self-employed, the SEP IRA, you have the IRA available to you, the taxable brokerage account. So there's a lot of options available. It's pretty hard to totally max out your investments because taxable brokerage doesn't have a limit. So if you hit your 401k contribution limit, your IRA, your HSA is another one that you could invest in, and you're like, hey, I have a lot of money left. Where should I put it? You can just put as much as you want into the taxable brokerage account, and that's going to help you guys a lot. So there's no cap on that one. How to invest in the S&P 500. I'm going to cover this because I feel like this isn't talked about enough because it's one of the most core fundamental things. So as we talked about this, guys, when you open one of these accounts, whether it be whatever account I talked about today, the S&P 500 could be bought within whichever one of those that you want. So when you go into one of those accounts, when this slide that we're on right here, where we're kind of breaking down the investment product, you're going to go into that account and say, hey, I want to select my investment product. And you're going to see these long lists of just boring long names. That's where you would select the Vanguard S&P 500, which would be like VFX. So the ticker symbol here is VBLAX, but on the S&P 500, it's VFX. If you're at a different brokerage, the ticker symbols are going to vary, but the core investment, it's still the S&P 500. It's just going to be like Fidelity's, I think, is FXAIX. Charles Schwab, I think, is like SWPPX. And so there's different ticker symbols, but you can easily Google like, hey, Fidelity S&P 500 fund, and you'll find the ticker really fast. Will compound interest occur in a taxable brokerage account with a stock that pays dividends such as Coca-Cola, AT&T, or APTS? How does compound interest actually work? Yes. So guys, compound interest happens in any investment account. It even technically happens in your bank accounts. In short, compound interest is when your money earns money and that money is reinvested and that money starts getting invested itself. So that happens with technically a bank account. It's just lower, levels of it, right? So if you're earning 0.006% in your checking account, well, compound interest, you're not really going to see much. You might get 20 cents back each, month or quarter. And so technically that 20 cents is back in your bank and earning interest, but at the same time, it's not much. So when you go into the market and you invest in like a dividend stock or whatever, and you say, hey, Coca-Cola is my main player. I want to roll with Coca-Cola for the next 20 years. And you're getting those dividend payments back, reinvest those dividend payments. And then those dividend payments are going to add to your total capital. And that money is going to grow at the same pace that already happening. And that's where compound interest is consistently happening. So if you're getting 10% every year in the market, if you have a $10,000 investment, you make 10%, quick math, that's $1,000, right? And then now you have $11,000. So that $11,000 is going to grow at 10% and so on and so forth. And that's kind of how compound interest works. So that happens with any investment, basically any account, but you have to be invested for it to really go into effect. Did you say that ETFs are more costly than index funds? No, ETFs and index funds are pretty much the same cost. Like I said, there are very few and far between differences between the two. They are ultimately the same thing. The biggest thing is the fractional shares that you can buy index funds with. Once you hit that $3,000 minimum, you can buy like, let's say $10 of a $200 share, whereas ETFs, you have to buy the whole $200 each time. But as a barrier of entry, like I was mentioning earlier, if that index fund has a $3,000 barrier of entry, but the ETF does not, it's easier for you to start with the ETFs in that situation. You can also kind of trade those more so than you would be able to like mess with an index fund. But cost, when it comes down to cost, which is the expense ratio, those are ultimately identical. Do you prefer a Roth IRA or deferred comp 401k, or is it the same thing? I'm just getting started. Yeah. So guys, so when it comes down to Roth, so a lot of times people are like, hey, I have a Roth. Really quickly. So I talk about this in my book, my investing book, is the Roth in the traditional is just like the coat, right? So if I walked up to you and I said, hey, I got a blue, you'd be like, what are you talking about? Like a blue what? And I'd say a blue coat. And you're like, oh, okay, that makes sense, right? So the same thing goes for traditional and Roth. It's like, if you say you have a traditional, well, I don't really know if you're talking about an IRA, a 401k, or something else, right? And when you look at it like that, you can say, hey, I have an IRA, I have a Roth IRA, I have a Roth 401k, or I have a traditional 401k. So the Roth in the traditional is just the tax designation wrapped around the actual account itself, whether it be 401k or IRA. So traditional is when you get the tax benefit now, and you're not paying taxes now. You contribute above the line, like per your paycheck before you're taxed. And you're saying, hey, I'm going to put $200 a month into the S&P 500 within my traditional IRA. Then that money is going to grow tax-free for, let's say, 20, 30 years. It gets to be 65 years old, and you're saying, hey, I need to take this money out. I'm going to withdraw this money. Well, at that point, you're going to be taxed with the traditional. Whereas a Roth is opposite. So you're going to get taxed on your paycheck, and whatever after money goes to your bank, you're going to invest. Let's say you still use $200. That $200 grows tax-free 20, 30 years, just like the traditional. At retirement, you don't pay tax. You can withdraw that money tax-free. And so that's the difference between the two. So the question is, hey, which one do you prefer? It comes down to tax rates. And I don't want to say blindly. I'm going to say blindly at this point in time, I would prefer the Roth because of where tax rates lie, but it comes down to tax rates and tax planning. So if you are 20 years old and you're in you're paying basically historically low tax rates that we have right now, it makes sense to take the burden, take the tax hit now and let that money grow tax-free forever have a couple $1,000,000 in your account and, withdraw that tax free. But if like tax rates are lower in your retirement phase, let's say you're making like $300,000 at a really young age. In retirement, you're going to probably only pool like $100,000 per year. Well, the money that you pool is your ordinary income, and that's what you're taxed at. So tax rates could change, and nobody knows that, but you're probably going to be actually earning less per year, therefore taxed at a lower rate. So traditional might make sense at that point to get the tax bill down now and reduce your tax bill currently. So that's how it works. I use a Roth personally. What we do is, so we have there's an income limit. So there's what's called a backdoor Roth, is where if you make over a certain limit, you have a combined household limit or individual. You basically put your money in a traditional 401k and then you backdoor it into a Roth. And so you make a big one-time lump sum contribution into traditional, you withdraw it and you basically send it to your Roth IRA, and then you pay the taxes on that conversion at that time. And that's a way for anybody to consistently, no matter where your income is, to consistently invest in the Roth. So I hope that helps there. Did you say that earlier you can buy bonds in certain companies? Yes. So bonds are bought in companies, guys, or the government. There's, at the state level, federal level, city level, even. I think Chris talks about possibly muni bonds or municipal bonds as well in his courses. That people always ask me that question. So yes, you can buy bonds. Basically, it's the company saying, "Hey, can we take out some debt on your name? Give us $5,000, whatever it is. We're going to give you that $5,000 back plus interest that you earned on that 5,000 for letting us hold your money for, let's say, 5-10 years or whatever, however long you let them hold it." And that's how bonds work in a nutshell. If we maxed out our IRA contribution, is there anything else that we can contribute to maybe for our kids? Yes. There's tons. The kid conversation, I'm going to briefly talk about it, but there's a really good presentation by the Wealth Dad, Sean. He did one on 529s versus UPMAs recently on childs. I was in that chat, so I chimed in the presentation as well. But I would say that the four main accounts that you could consider would be the 529 or ESA, the UPMA or UGMA, same thing, the Roth IRA for a child, or a taxable brokerage account. Now, they all are going to have different tax implications, so I don't want to get too in detail with that, because that's a whole nother 40-minute conversation itself, and Sean's presentation pretty much covers that. But those are the four options, I think. And so, yeah, for a child, I would probably use, to my benefit, all four of those at some point, depending on how much you have available to contribute for them. What do you suggest for mutual funds? Where to get started? So I like to look at broad cost, low index funds, broad market, low cost index funds, because they're the cheapest. You're going to meet the market returns. Some people don't find that appealing. That's fine. Like I said, every investor is going to be different, but you're going to be pretty safe, right? Like you're going to be exactly what the market makes. And historically, there was actually a study done with I think Fidelity did it from 03 to 2018. Large cap funds, there was only 8% of large cap funds that beat the S&P 500. So if you held the S&P 500, you were in the top 8% of large cap actively managed mutual funds. So like I said, index funds, mutual funds, ETFs are all kind of the same thing at the end of the day. And that's kind of where I would start with an S&P 500, a total world stock market like VT-WAX. I showed in one of the slides up there, VT-SAX, which is the total stock market, which is the US stock market. Something like that would be a really good place to start. Can you explain where to do stock options? What platform? Yeah, E-Trade, TD Ameritrade. I know Robinhood. I think I've never used Robinhood. I also don't do any options trading at this point, but I have a TD Ameritrade practice account that I think is really beneficial. And for anyone listening, by the way, I actually used the TD Ameritrade account today. I did a presentation for a 6th grade class. And so I have a free resource. If anybody wants to teach their kids on the stock market, it's a really, really easy 13 slide, slideshow for as fundamental and basic as the stock market could be for their child to learn. It's only 13 slides. It's free. It's in I posted my tweet today in the Wall Squad all over, so people had access to it. But if you guys go to my Instagram, go to my Twitter or my Facebook, just go to the link in bio, hit shop now, and then you can go into the very, very bottom of the shop, and there's a free slideshow that you can present to your kid that helps them kind of understand the stock market in a nutshell. It's extremely basic. That's why it's free. But I just wanted to let you guys know that that's available to you guys. Are you penalized for withdrawing funds from a Roth IRA? Yes and no. So the Roth IRA is kind of interesting. So the contributions into the Roth IRA can be pulled at any time without penalty. I can't remember exactly. There's like 5 different rules. The rule of, I think 55T it's called or something like that. You guys can look it up and see the exceptions that where you're allowed to withdraw those, even the earnings on it, I think earlier than retirement. But for the most part, if you withdraw money from your retirement account, you're going to get paid taxed ordinary income tax rate plus a 10% penalty. And so that's where it becomes less attractive for a lot of people. Is they're like, hey, I want this money earlier than 65 or 59 and a half. And that's where the taxable brokerage comes into play. So I think both of them have a route to use. It just kind of depends what you're looking for with the account and what the goal of the account is. Where's the best website to determine ETF and their history for beginners? Yahoo Finance, I know, is a good one. What I use and what I talk about in my book actually is just going and looking at the prospectus or the fact sheet. So if you go look up like VFX, like the S&P 500 fact sheet, you're going to get all the information on historical performance. You're going to get the top 10 holdings. You're going to get the expense ratio. You're going to get a breakdown of the fundamental, what is the fund itself, what is its goal, its investment objective, its dividend payout history. Everything is in basically what the investor wants to look at on the fact sheet or the prospectus. The prospectus is the annual letter that's sent to every investor in the fund, invested in the fund, that's sent out to you guys. So those are the 2 places I would actually look. Outside of that, probably Yahoo Finance. Morningstar, Market Watch is good for some market advice, all that kind of stuff. And FYI, guys, I see 95 messages in here, so I'm making my way down. I'll keep going for sure. We have at least 15 more minutes. I just don't know if I can get to all 100 messages. Let's see. So I just opened a Roth IRA with TD Ameritrade. Do I have to select mutual funds, ETFs myself since it's hands-on? Yes. So I actually tweeted about this yesterday. This is everybody. If anybody's tuned out to my annoying voice at this point, please listen to this. If you guys are invested into a 401k, an IRA, or anything, please do me the favor of going into your account and seeing what it's invested in. There have been horror stories where people have so-called invested into a Roth IRA for 20, 30 years. They get to retirement, they've never really checked it, and they realized it was in a cash or money market fund. This will literally save your life if you don't know where it's invested. And please do this, because this could literally change your future from listening to this presentation. So you have to select your mutual funds and ETFs or whatever investment products you want within those accounts. And I would do so. So yes, make sure that every time you open an account, you know where your money's going, you know what it's invested in. The 401k is not the investment. The IRA is not the investment. It's these investment products that we broke down here, the assets we talked about up there, and all that stuff. So please, please, please do that. On my Instagram, I actually tweeted about that, I think yesterday, because I heard a horror story where somebody held it in a money market account for 30 years and had like a 1% return on their money. So I don't want that to be you guys. Yes, Roth IRA can be in Webull, I believe. I don't see why not. I knew TD Ameritrade, some people have them in there. They can be held pretty much wherever. Can I open a Roth IRA for a minor? Yes, covered that one. Definitely. They have to have working income, so taxable income that's actually filed with the government and the IRS. So you have to actually say, hey, my daughter, my son, they shoveled snow, they cut grass, they made $5,000. I invested that $5,000 into a Roth IRA. So that's the way you can do it. If for anybody self-employed out here, so this is a really good hack. I think Chris uses this as well, and I'm going to be using this here soon when I go self-employed. Is when I have a kid, I'm going to use them in some sort of way, and you can get creative with this, as part of my business. And so even if they're 1 year old, 2 years old, you could hire them as a model and take pictures of them and post them on Instagram and say that they are a model for your business. And you can actually pay them a salary. And then basically you would invest that salary into the Roth IRA. So you can, even if they're 1 year old and technically they're not really doing anything, as long as you can reasonably, talk to the IRS and say, hey, this is, I'm using them for my business, you can basically invest in a Roth IRA. So take advantage of that, especially self-employed people that have a business on the side and have a young son or daughter. That's a really good option.
How do you know what you're invested in on here?
What's that?
How do you know what you're invested in? Like I opened up a Roth, like since we've been talking.
Yeah.
And I already have one through my job. I already have an IRA through my job. But what you said about knowing where your money is going.
Yeah.
So I'm actually in Vanguard as we speak, but I don't see where you can tell where your money is actually going.
Yeah, I got you. So if you go to Vanguard.com and you're in your account, have you clicked on your account itself?
Yep, I'm in it. I'm in the one that I just created since we've been on the phone, my Roth.
Okay.
And I'm in my actual IRA.
Okay, gotcha. Does it say money market? Do you see in there like a federal money market fund?
No.
What kind of fund do you see any? It's kind of hard to do it over the screen without being able to see it, but you should say like within the account, you should see like an investment that your money is. Did you contribute some money tonight?
No, not tonight.
Oh, you just opened it?
Yeah, and that's another question. How like with the Roth that you just mentioned about opening, this is not the IRA that I have with my job. This is one that I'm just opening to invest in. How do you know how much to give to it a month or a week, however you want to invest?
Yeah, so that's totally up to you. If you want to do like what I do is I basically take $6,000, I divide it by 26 pay periods. So every time I get paid, I put $231 approximately in there. And so I know at the end of the year, I'm going to hit my maximum, but it really depends. Like my word of advice for retirement is 15% of your annual gross income. So if you make $50,000 per year, I would say, hey, $7,500 needs to go to retirement. And I would probably space it out on a biweekly schedule. But everybody's different of how much they can invest, how much they should invest, how much they believe in, But does that kind of make sense?
Oh yeah, definitely.
Okay, perfect. Yeah. And so when you contribute your money, it's going to say like, hey, where do you want to put this money? And you're going to probably be put into a money market fund. So you basically just, it's a technical step that you have to go through. You could remember guys, you can call customer service. Customer service at Vanguard is fantastic. They will walk you through the technical steps of everything. I don't remember off the top of my head exactly every step you take, but essentially you're going to buy shares in whatever index or investment product that you want. And then that's where you're going to say, hey, I want my money every time I contribute this $300 to go to this fund 100%. And you'll allocate percent wise where that money is going to go.
Okay. I see up in my the fund that I just opened, I do see something that says Vanguard Federal Money Market Fund Settlement Fund.
Yes. That. So that's what I was referring. Yeah, I figured. That's actually where mine was as well. And so you have to actually update that to say, hey, I don't want it to go. So when you look at that, what's the ticker on that? Do you know?
No, I don't.
It should say like VMFXX or something like that. Basically, you're going to update that VMFXX, which is a cash account essentially right now, to like, let's say VFX or VTX, whatever kind of investment that you want. And so you'll put your money there, and then you can see the account summary of where your money's going, where it's at currently, and all that kind of stuff. So that's what you're going to change. And that's a good point that you make, because when you open it, a lot of times people don't change it and they just start contributing and forget to actually select the investment product within. And that's where what I was referring to a couple minutes ago.
I think by default, if you have a job and you have one, because I'm looking at my one with my job, it's automatically in the VTIVX, and I didn't even do that.
Yeah, so VTIVX is the target date fund. So with your work, you have a 401k. With the one you just opened is an IRA. So same retirement, goal there, but their 401k, the 401k, typically all these big companies will default you into a target date fund. So that is invested into an investment product. I personally am not big on the target date funds. I would change it to kind of some of the ones I've talked about tonight. But that's, I don't want to lead you down the wrong way or give you investment advice over the phone without knowing the full situation. But I would just tell you the target date funds they're good funds. They're going to constantly be working for you. But they're sometimes on the higher expense side. Vanguards are pretty low, relatively speaking. You're probably in the teens in the expense ratio, probably 0.14 is where you're at with that fund. But that's at least invested into the market.
Right.
Yeah. So that's what you could do with your Roth IRA as well. Change that to one of those types of funds.
Okay. Thanks, man.
Yep. All right, guys. Does anybody else have a question they just want to talk out loud? There's like 100+ messages in there. I can keep going through them if no one has questions out loud. But I want to open it up to you guys.
Yes, I had a question.
Yeah, go for it.
In regards to, you said maxing out up to 6,000 annually. If you say you don't have a few good years and you're doing 6,000 for the first 3 years, that fourth year, say if it comes on tough time, we get hit with another COVID or a lockdown, can you alter that to say like 2,000, 3,000, or once you get set to a certain price, a premium, you have to pay that premium annually?
Yeah, you can invest. I mean, it's technically up to you as how much you want to invest. So if let's say, tough times hit and you're like, hey, I can't contribute that $4,000 I was doing, you can scale back your contributions. You can either do automatic or manual contributions. I always advise automatic. And then if like tough times hit, you could go in there in your account and then scale back or cease contributions, whatever you want.
Oh, so it's all customizable to what you can do or what you want to do.
Yeah, correct. You could put $2 in your Roth IRA or 6,000.
Gotcha. Appreciate it.
Yep.
What happens if you miscalculate and you contribute more than the 6K? Do you get penalized? Can you make it so it automatically rolls over to another investment account, or is it just returned to you?
Yeah, that's a good question. You actually get penalized by the IRS for doing so. Now, when you go through a lot of these accounts, they're kind of set up to help you guys, like for somebody not to accidentally overinvest. If you want to max it out, there's typically like a button that you just check mark versus like trying to calculate it yourself. In that, so like it's gonna automatically calculate based on wherever you are during the year throughout the rest of the year to evenly do that for you. So it's pretty hard to go over unless you just like say like, hey, I'm gonna do $500 every 2 weeks. Well, yeah, you're gonna blow that $6,000 limit.
Yeah.
But you should be fine. But yeah, you'll get penalized and there'll be tax complications with that. So yeah, be aware of that.
Okay. Thank you.
Yep.
Quick question. Is a Roth IRA or a traditional IRA as volatile as having a 401k?
So it depends the investment product that you select within the account. So 401ks, like I was saying, IRAs are just the account itself. So you could be in a money market fund, which is a cash account like we were talking about. And that would be that'd be basically your bank account, right? Or you could say, hey, I'm going to go buy Tesla, 100% of shares. All my money's going to Tesla. Well, that could be extremely volatile. Or I want to go buy GameStop. You never know what's going to happen with that. So it depends the investment that you actually select within the account.
Okay, so you have the option of choosing exactly where you want to invest.
Yeah, correct.
Okay. Appreciate it.
Yep. When you get in there, guys, you'll see like an investment lineup, and that's why this slide is what it is. You'll see this long list of investment lineups, everything they have to offer, and that's why I was breaking this down for you, so you can kind of read through on a quick, you understand the investment product a little better, and figure out what you're kind of looking for.
Hi, I have a question. So, between the two index funds and ETFs, is there an advantage of choosing one over the other, or are they just the same?
When you select an index fund or an ETF of the same one?
I mean, is there an advantage of choosing? Yeah, like, is there an advantage of choosing one or the other, or does it not matter?
So if you pick like the S&P 500, if you're like, hey, I want to invest in the S&P 500 and I'm going to invest in an ETF S&P 500 or an index fund S&P 500, there's really no difference outside of the two differences I talked about earlier, which is like the fractional, you can't buy ETFs and fractional shares yet in all platforms. Some you can, some you can't. So and then you can also day trade or trade your ETF during the daytime, which is more beneficial for a lot of people than the index fund. So those are the only two differences. So they're pretty similar. So there's not a huge difference, but that would be technically the benefit, I guess you could see it as.
Okay, and earlier you mentioned that some index funds have a minimum that you can contribute.
Mhm.
So how do I know what those are? Will they tell me when I try to buy them?
Yeah, so like when you open like a Vanguard or Roth IRA, it will say, "Hey, this fund's a minimum of $3,000." That's typically what you see at Vanguard. Every broker is going to be different as to what their minimums are. I don't know. I can't speak on it for every single broker. I just know through Vanguard it's $3,000. But they will explicitly say like, "Hey, this is a minimum investment." But that's where I say like, consider the ETF in that case because you can buy it way cheaper.
Okay, and that's specific to the fund, right? Because not all index funds will have that minimum.
Correct. So that would be specific to that fund individually.
Okay. Thank you.
I have a question.
Yeah.
You were saying for people that's unemployed, like I don't have an employer, I'm unemployed. What was the option I could go into in regards? Because since I don't have a 401k option.
The Roth IRA. So if you're an employee, a W-2 employee, I take it. Is that what you said? You were just a W-2 employee?
No, I'm unemployed. I'm sorry. I'm
unemployed. Okay, so
yeah.
So as an unemployed, you have to have earned income. So if you're not filing income tax with the government right now, you cannot contribute to that. But that's where I would go like a taxable brokerage account for the little amount of time that you're going to be unemployed, assuming that you get back in the workforce.
I have a question.
Yep.
So through my company, I have a 401k through Fidelity. I recently opened up a BrokerLink account where I'm trading some stocks. So I transfer some money over. So I have over like 25,000 in it, and they kind of dinged me because I wanted to do options, and I guess I violated because I did a couple day trades. In that company account, shouldn't I be able to day trade within that, or is that just the rules that are part of the program?
That actually happened with my friend as well in Robinhood. There's those platforms that are gonna basically mark if you do X amount of trades and mark you as a day trader and like restrict you. I don't know. It is legitimate what's going on. I don't know the rules, and everyone's gonna have a different rule. But if you do break those technical rules, they will like suspend your account or something like that. So that doesn't surprise me. But I don't know the exact like reasons as to why they would, if that makes sense.
Yeah. Thanks.
Yep.
Yeah, I had a question
I had a question.
Yeah.
I'm
Go
sorry.
for it, guys.
I had a question. So you had mentioned there's a way to get around investing into a Roth IRA beyond the limit, like it's like the 6K limit if you had more in the year by doing a backdoor. I don't know if you mentioned a backdoor IRA where you put like a lump sum in and then you transfer it and you pay the taxes and the fees. Could you explain that again?
Yeah, so $6,000 is always the limit for any IRA that you do. If you make over like your earned income is over a specific amount. So as an individual, it's like 137,000. As a married filing jointly, like a joint household, it's like 206,000 approximately. So if you make over those limits, you aren't allowed to technically invest into a Roth IRA. So what you would have to do is invest into a traditional IRA, and then you would have to backdoor it into a Roth. And so that's legal per the tax code to do. And with I think the Trump tax law actually outlawed. So you used to be able to like kind of play with it. Like you could basically recharacterize. So if you went to the back door and transfer that money, you could actually recharacterize and put it back in traditional based on where your taxes fell and where it made sense to do it, the tax break at. But Trump's tax law, I believe, outlawed that recharacterization. So you can only do it one time. But once you do that, that's basically what you're doing is basically taking it from traditional to Roth, but it's still $6,000 regardless of where you're putting it.
Okay, thank you.
Yep.
Question,
question
what is
about
your
REITs.
opinion on your, like doing like the Roth or like a life insurance policy that has the compounded interest? What is like your take on the negatives or positive on that?
Yeah, that's a good question. I get this a lot. So the IULs, I hear a lot.
Yeah.
Index Universal Life, I hear whole life insurance. In a nutshell, I would, when it comes to insurance, I would not mix my investments with my insurance, and this is why. So your term life insurance is going to be your cheapest product on the market versus the IULs, the whole lives. It's going to be 1/10 of that price, 10% of the price. And so I always invest in term life insurance for the purpose of life insurance, and then I invest everything else, the 90% else that I would have, been paying with the whole life. The appeal for the IUL is there's strategy behind it with like the savings and stuff and like a cash account, cash value plan. And what that does is they say, hey, you're going to put, X amount of dollars in this cash value plan, and it's going to be invested into an index, the index universal life, right? So like the S&P 500, but there's going to be caps on that. And there's also, but the benefit of it is like, hey, if the market dips below 0%, there's a floor to it. And so that's where they're going to sell you on it is like, hey, if it goes below 0, you're safe. But if it goes up to 30%, well, you're probably capped at like, let's say 15%. I don't know. Everyone's going to have a different cap, but there's basically like a restriction on your earnings. And that's what I don't like about them. And they're 10 times more cheap or 10 times more expensive. So I would stay out of them. I would definitely invest in your term life with your insurance needs and then go invest everything else.
Gotcha. Thanks.
Yep.
I have a question about REITs. I wanted to invest in, I'm interested in investing in a REIT, but wanted to contribute to one that my condo community is a part of. How do I find out if the developers of the condo community is a part of a REIT or not?
Yeah. So when I was talking about the how to look up like the funds or whatever, so your prospectus and your fact sheet is going to tell you exactly what the REIT that you're looking for, what's all in it, the top holdings, all that kind of stuff. So that's going to be the same for that, and they're gonna have all that information on there. So if you go to your apartment complex and you're like, hey, do you guys actually have a REIT? They might not have one personally. Like if it's like just a local apartment complex, they might not even have that available. But you could probably talk to somebody there and just say, hey, are you guys part of a publicly traded REIT out there? Does anybody basically do your real estate planning and all that kind of stuff and maintenance and stuff? And you could probably just ask like them at the front desk or whatever, not front desk, but like whoever's in charge of the condo or apartment.
Yeah, like a property manager or the
Probably,
HOA.
yeah, somebody like that. That's going to kind of know who's running the show. And then you can probably search whoever that is publicly and then see if they have a REIT attached to them and then look at the fact sheet and kind of see what's within that.
Okay.
All right, guys, I'm going to take like, how about let's do 5 more questions. We're a little past 9:30, but we're all good. So I'll take 5 more questions.
I just looked on your page and I was trying to find the stocks for kids that you said that you had.
Yes.
Is it on your?
Yeah,
Go
go
ahead.
to link in bio, and then go to shop now. I think it's like 4 or 5 down the links. And then at the very bottom of my store, you'll see like there's no picture. I uploaded it last second today after I presented it. It just says stock market child slides. And you should see it there.
I do. I see it's all the way at the bottom. Yep.
Yep. All right. You should be good then.
Thank you.
Yep.
You have a HSA. I just got a notification that I can invest the money that's in there. Is it better to just let it sit to pay the medical bills just in case you come across a big loss, or what are your thoughts about that?
So HSA is actually my favorite investment account, and I use this personally for retirement because I know, I think the average price average cost of medical cost per individual or something's like $300,000 past 65. So we're going to have medical bills. So it kind of depends what your budget looks like as to if you can invest. I think the default method would be, hey, let's use the HSA for the purpose of paying medical bills in the current moment, unless I have the flexibility to afford it with cash right now. So there's a triple taxation that is a really big benefit to this account. And so basically anything you contribute is tax-free. the investments will grow tax-free. And again, you'll have to select the investments within the account. There's usually like a cash account it sits in unless you go invest it. And you usually have to keep like $1,000 or $2,000 as a minimum in cash because of like medical concerns and stuff like that. But anything over that amount, you can go invest and take and say, hey, I want to invest this in X, Y, and Z. And so if you invest that money, it's growing forever, and you don't really need, you can pay out of pocket for medical expenses now, and you have that benefit, then you can save your receipts, and then at a later date, you can actually pull that money tax-free. Or you can use it for a medical expense. So it's kind of at your discretion as to how you use it. I personally use it for, we pay everything out of with our cash. So we try to budget really tight to where if her or I go to a doctor visit, we just pay with our debit card, save that receipt. And then later I know, hey, that money's invested and I can pull this money tax-free. But the primary purpose is for the health, obviously. So there's benefits. It's at your discretion.
Do you offer any, oh, I'm sorry. I was going to say, do you offer any one-on-one consultations?
Yeah, so actually in my link in my bio and all my profiles, I have a book a consultation link, and I have a few different options as to availability of what you guys are looking for. So pretty flexible with there's 3 options: the starter kit, the financial planning, and the financial planning and coaching. It's very detailed as to what each provides. But you know, I'm also very flexible. If you guys are looking for something outside of exactly what that provides, just talk to me. I do client calls pretty much all day. Saturday and Sunday is my availability right now. So like this Saturday, I have like 4 or 5 clients lined up and a podcast, but my availability will be on there. It's really easy to schedule, and you can get started whenever you guys want.
Thanks.
Yep.
My question is, earlier you briefly mentioned the short-term and long-term capital gain. As far as swing trading go, if you don't pull the funds out of the account, let's say transfer to your personal bank account,
yep,
would you have to pay taxes on it? Or if it just sits in Ameritrade to trade later on to another type of stock, then you won't have to pay capital gains on
that's a
it,
good
right?
question as well.
Or taxes on it.
Yep. So you will pay taxes. So if you guys sell a stock or whatever, you will owe taxes on that capital gain that you received from that, even if you're basically taking that, keeping it within the account, investing in other different stocks. So you will be, taxed on that. So a lot of people are like, hey, if I keep it in the account, is it fine? Well, it's actually the assets that are bought and sold within the account. So cap gains tax also happens with if you're in a mutual fund and you just hold a mutual fund all year long. Think back to the presentation when I talked about mutual funds. It is a group of companies, right? And there's an active mutual fund manager buying and selling securities within that fund. So although you're not actually selling the fund or, trading it, there's activity that's happening within that fund. And there's a small cap gains tax hit on you every single year, charged by the fund essentially. So any activity that happens within is taxed at capital gains.
Thank you.
Yep. All right, guys, I got 2 more questions I can take.
Which shares are best? The F shares or Y shares for foreign stocks?
The F shares or Y shares?
Yes, for foreign stocks.
Foreign stocks. I don't know the answer to that actually. I'm trying to think of what that actually means first off to understand what's going on.
So let's just say like you're trying to trade for 7-Eleven, right? 7-Eleven is a foreign stock that's in Japan. And the ticker symbol is SVNDF. That's the foreign one. And they have SVNDY, which is the ADR. Which one would be better to invest in?
So I actually don't know that, so I don't want to talk out, say something wrong. I am reading right now that F shares often have much lower liquidity, meaning the price will buck up and down more. That's all. I'm just reading this off the internet. Let me do some research on that, and just DM me and I'll get you a good answer once I do some research. I've seen it before, but I'm not 100% sure the difference between the two.
Okay, thank you.
Yep.
Can you announce your IG handle? I'm sorry.
Oh yeah, sorry guys. It's Budget Dog. So it's BUDGET budget and then dog. And you'll see me also in Twitter and in Facebook as well as Budget Dog. But if you go to any of my social media handles, you'll see the link in bio has all my connects. So you'll see me on LinkedIn, you'll see me on Facebook, Instagram, Twitter. So it doesn't matter which social you catch me at, you'll be able to connect with me everywhere.
Thank you.
Yep.
How did you decide which mutual fund to invest in?
So that's a loaded question. That's a good question. I'm just trying to think of how to answer this the best way. So I did write an investing book on this to really, really break down like everything you need to consider. And so that's like a 75-page ebook to discuss that. So there's some things there that I want to bring up to your attention. So like, first off, like age is a big piece of this. Your risk profile, like how risky, like just think about generally, not even investment wise, like, are you a risk taker, risk seeker, risk averse, etc. And then figure out what your goal of the account is. And then you can kind of back into figuring out, hey, am I back to that Morningstar chart that we saw in the beginning of the presentation, where do I fall on the risk level here? Like if you're looking at this chart here, am I trying to get really risky and do small cap growth stocks, individual stocks? Because that's probably the riskiest you can get, right? Or am I trying to do a large value index fund, or large growth, large cap growth index fund, and kind of keep it safer? So it's hard to answer that question because everybody's different. I will tell you, most people will default to the broad market ones that I talk about a lot, like the S&P 500, the total stock market, total international stock market ones. Those are ones that you cannot go wrong with. You will win with, and you'll meet market returns. And so that's probably the best to have most exposure on. Some people are like, hey, I want to do 60% in domestic equities, so like US stock, and then like 30% in international. And then I want to take that 10% remaining and really put it in something risky. Bitcoin, maybe a small cap stock that you're like GameStop or something like that, like something extremely risky. And so every investor has different preferences. The best advice is saying like, hey, look at those factors I talked about: age, risk profile, all that stuff. Look at my rule of thumb that we talked about in this presentation, about 120 minus minus your age, to figure out the percent of like stock and allocation that you're trying to allocate the most. And then start with the broad market funds, and then kind of work your way into sector-based funds. Like VGT, for example, is like a technology fund that's, outperformed the market the last 10 years. And so you got to look at it that way. It's tough to kind of give you a quick, dirty answer. But I do explain that in my Investing 101 ebook in great depth. And I think it more so teaches you. So like a lot of people are like, hey, what stock should I invest in? And it's hard to say, hey, you should invest in J&J or Coca-Cola, because like, I don't know your situation. So to blindly say that's almost, not professional on my end, I feel bad giving that advice, because I'd rather teach you about the whole picture, and so that you can go out and actually do it yourself. It's kind of like teach a man how to fish, and they're going to, eat for a lifetime kind of thing. Same principle there. So I don't want to say like one way or the other, but I hope that kind of gives you a general indication of kind of like where I'm going with it.
Yeah, it did. Thank you. I appreciate it.
Yep. All right, guys, I will take one more question. Trey Trades, I think, raise your hand.
Hey, how's it going?
Good, man. What's up?
I just joined late. Like, I'm so embarrassed. I literally just got up to my office, and I was going through the Discord, and I was like, oh my gosh, I just missed this whole training. I was like, I've been eyeing since I saw it posted. I was like, okay, I can't wait to sit down and take some notes and stuff like that. Will this be recorded and posted in the lessons or anything like that?
Yeah, so all things are going to be posted to Wealth Squad University. I think I saw and they're mentioning here that he was going to upload this tonight. So this will be recorded and anybody can watch any. I have another stock market presentation as well as a budget presentation a couple weeks and a month ago. So you
Yeah,
guys,
I watched your budget presentation. I was here.
Yep. So you will have access to it.
Okay, sweet. And one more thing, have you ever like posted these PowerPoints at all, just for like reference for us to use?
I have not. So I keep this within the Wealth Squad specifically.
Okay.
Now I am coming out with an investing course when I hit 100,000 on Instagram, a budgeting course when I hit 50,000. So things like this will be available eventually. But at this point, my store, if you guys go look at my link in bio, everything is available there. So any of my socials have my link in bio. Everything I offer currently is listed there. But yes, eventually these will be kind of out and about. But for now, it's just Wealth Squad.
Okay. Thank you so much. I appreciate it.
Yep. All right, guys. Hey, I appreciate everybody tuning in. We had a pretty big squad tonight. But come with me. Obviously we can only do this for, an hour and a half hour, here and there. But if you guys have additional questions, find me on my social medias. I'm always willing to answer. I usually voice message. It's just easier and gets the point across better. So hit me up in the DMs. Obviously I'll be a Wealth Squad. So tag me if you guys have questions in any of the chats. I'm always there to help. So other than that, connect with me on all the socials and I will talk to you guys soon.
Thanks, man.
Appreciate you.
It, guys.
Thank you.
Thank you so much.
Thanks, guys.
Appreciate it. Good looking.
Thank you. Thank you.
Thank you. Great presentation.
Thanks,
Thank
guys.
you. Learned a lot.
Thank
Thanks.
you. Appreciate you. What's the Instagram handle?
It's Budget Dog.
DOG?
Yeah, DOG.
Okay, got it. Appreciate you.
Thanks, guys. Appreciate all
Thanks
the
a lot.
support.
Thanks a lot. Appreciate you.